So, you want to own a hedge fund? Here's the strange part. A hedge fund is a business where the fee runs whether you win or lose. You collect on the way up and you collect on the way down. The investor takes the risk, you take the cut. And somehow for decades, the smartest money in the world kept agreeing to this. It's also the business where 2 Nobel Prize winners, the smartest men in the room by any definition, built the most sophisticated financial machine in history and then blew up $4.6 billion in 4 months. Let's start with what a hedge fund actually is, because most people get this wrong. It's not a building, it's not a trading floor, it's a legal structure. Specifically, it's a private limited partnership. You are the general partner, your investors are the limited partners. They put in the money, you control how it's invested, and in exchange, you take a cut of everything, whether you win or lose. The cheapest way in is to start one yourself. Legal formation of a basic domestic fund runs between $25,000 and $100,000. That gets you the partnership agreement, the private placement memorandum, the document you hand to every investor before they give you $1, and SEC registration if your assets under management cross $150 million. Add a fund administrator to independently calculate your returns, a prime broker to execute your trades and lend you capital, an annual audit, compliance software, cyber insurance, and a Bloomberg terminal, and your total annual operating overhead runs $500,000 to $1.5 million before you've made a single trade. That's the lean version. If you want a proper office in Manhattan, because serious allocators will not wire you money from a WeWork, add another $200,000 to $500,000 a year just for rent and a small team. The smarter route, and the one that most serious managers take, is to spin out of an existing fund. You spend 3 to 5 years at a Goldman Sachs or a Citadel. You build a track record under someone else's infrastructure, and you leave with a $50 million anchor investment from your former employer and a list of institutional contacts who already trust you. Instant credibility, instant assets under management, no 2-year cold start. But there's an entry that makes all of this look expensive. If you want to run a fund in Singapore, the Monetary Authority of Singapore will issue you a variable capital company license for roughly $5,000 in filing fee. This is exactly why half the macro traders who left New York in the last 5 years now have offices on Orchard Road. In the hedge fund world, geography is a cost center. There's also one entry you cannot buy regardless of what you're willing to pay. The Medallion Fund, run by Renaissance Technologies on Long Island, has returned 66% per year before fees since 1988. No fund in history comes close. It is closed to outside investors. Has been since 1993. The people inside it are not selling. Now, before we get to how the money is made, let's talk about the daily cost of just existing, because this is the number nobody warns you about. On day one of ownership, before you've executed a single trade, the clock is running. Your prime broker charges a minimum monthly fee. Your administrator charges a minimum monthly fee. Your compliance software charges a monthly fee. Your Bloomberg terminal costs $2,000 a month per user, non-negotiable. Add legal retainer, audit accrual, directors and officers insurance, and payroll for even a skeleton team of 3, and your base burn rate is somewhere between $80,000 and $150,000 a month. That's $1 million to $1.8 million a year, leaving the building before you've touched a single position. This is why the industry has a number. Below $100 million in assets under management, a hedge fund is not really a business. It's an expensive experiment. The 2% management fee on $100 million generates $2 million a year. After operating costs, there's almost nothing left. You are entirely dependent on your performance fee, which you only collect when you make money, just to keep the lights on. This is why roughly half of all new hedge funds close within 3 years of launching. Not because they traded badly, because they couldn't survive the fixed cost of trading at all. So how does the money actually get made? Picture this. You're a real estate agent, but instead of selling houses, you manage someone else's rental properties. Every month, regardless of whether the tenants pay or the roof leaks, you take 2% of the property's value as your management fee. And if the property goes up in value, if you found the right tenants, renovated smartly, timed the market, you take 20% of the gain on top. The landlord owns the building, you manage it. You get paid either way. That's a hedge fund, and the fee structure has a name, 2 and 20. The 2 means you charge 2% of your assets under management every single year. On $1 billion, that's $20 million, automatically, January 1st. Whether you made money or not, whether you lost money or not, whether markets went up, down, or sideways, the fee comes first. Your investors are paying for the privilege of letting you try. Here's how that looks in practice. You raise $500 million. Your management fee is $10 million a year. That's your salary, your rent, your team, your Bloomberg terminals, your lawyer. It's a business, not a trade. You haven't returned $1 yet, and you've already collected $10 million. The 20 means you take 20% of every dollar of profit you generate above a set threshold. Your $500 million fund returns 15% in a year. That's $75 million in profit. You take 15 million of it. Your investors keep 60 million. You didn't put up the 500 million. You didn't take the risk. You took $15 million anyway. Now run those two numbers together. $10 million management fee plus $15 million performance fee equals $25 million for one good year on a $500 million fund. That is 5% of your investors' capital, paid to you regardless of what they actually needed to make the year work. This is the inversion that most people miss. Everyone thinks hedge funds are about making money on great trades. That's the 20. The real business is the 2. The management fee is the annuity. The performance fee is the bonus. And unlike your investors, you collect the annuity even in years when you hand them a loss. But here's where it gets more interesting. The 2 in 20 model has a hidden mechanism called a high watermark. If your fund drops 20% one year, you don't collect performance fees the next year until you've clawed back above the previous peak. Your investors won't pay you twice for recovering from a hole you dug. This sounds reasonable until you do the math on what it means for you as the manager. To recover from a 20% loss, you need a 25% gain just to get back to zero, and then another year of gains before you see another dollar of carry. Most hedge fund managers in this situation don't wait. They shut the fund down, start a new one, and begin the fee clock fresh, which is exactly why the hedge fund industry has a new fund launch every single week. The structure is what makes the money, not the genius, the structure. In 1994, John Merriweather, the former head of bond trading at Salomon Brothers, founded Long-Term Capital Management. His board included Myron Scholes and Robert Merton, two academics who had won the Nobel Prize in Economics the year before for inventing the mathematical models that modern derivatives markets run on. These were not lucky men. These were the men who built the machine everyone else was using. By 1997, Long-Term Capital Management had $4.7 billion in equity capital, but the fund's actual balance sheet exposure was $125 billion. They were leveraged 25 to 1. For every dollar their investors put in, the fund had borrowed 24 more from the banks. Their model said this was fine because their positions were hedged. The risk cancelled out. In theory, in August 1998, Russia defaulted on its government debt. This was not a position the fund had taken. It was a completely separate event. But when Russia defaulted, the entire global bond market moved in the same direction at the same time, at a scale the models had never seen. Every hedge in the book stopped working simultaneously. In August 1998 alone, the fund lost $1.85 billion. In a single day, August 21st, they lost $553 million. 6 weeks later, capital had fallen to $600 million. The balance sheet exposure was still over $100 billion. Their leverage ratio had gone from 25 to 1 to 167 to 1. The Federal Reserve Bank of New York called an emergency meeting. They convened 14 of the world's largest banks, Goldman Sachs, Merrill Lynch, JP Morgan, Deutsche Bank, and 10 others, and told them they needed to inject $3.625 billion to prevent the fund from liquidating its positions in a fire sale that would have crashed global credit markets. The banks agreed. The original investors, the ones who had built the models, the Nobel laureates, and the Salomon veterans, they walked away with 10 cents on the dollar. The fund that had returned 40% a year for 4 consecutive years, built by the smartest people in the room, was bailed out by the government in under 5 months. The second way this business kills you has nothing to do with leverage. It has to do with a man almost nobody had heard of until the week he lost everything. Bill Hwang had previously run a hedge fund called Tiger Asia. After pleading guilty to insider trading in 2012, no prime broker would touch him as a registered fund manager, so he found a loophole. He restructured as a family office, a private vehicle with far less regulatory oversight than a registered fund, and started again. Under that structure, he didn't have to disclose positions the way a registered manager would. He used that invisibility to do something that should have been impossible. By early 2021, Hwang had grown his vehicle, Archegos Capital Management, to roughly $36 billion in assets. The way he did it was through total return swaps, a derivative where the bank holds the underlying stock and Hwang gets the price exposure without having to disclose ownership. He was doing this simultaneously with 6 different banks, each of which thought they were his primary exposure. None of them knew about the others. On March 26, 2021, a few of Hwang's concentrated positions started falling. The banks issued margin call. Hwang couldn't pay. The banks began liquidating simultaneously. Viacom CBS dropped 27% in a single day. Baidu fell 33%. In 2 days, Bill Hwang lost $20 billion. Credit Suisse lost $5.5 billion. Nomura lost $2.85 billion. Morgan Stanley lost nearly $1 billion. In November 2024, Hwang was sentenced to 18 years in federal prison for fraud and racketeering. Credit Suisse, which had already been weakened by the Archegos losses, collapsed entirely 2 years later and was absorbed by UBS. A single undisclosed position, $20 billion, 18 years. The hedge fund industry's second failure mode is not volatility. It's the position you're so confident about that you don't think it needs a size limit. Now zoom out. There are roughly 30,000 hedge funds operating globally today, managing approximately $4 trillion in assets. Most of them are doing something extremely simple. They are collecting the 2% management fee, trying not to blow up, and calling themselves alpha generators. But right now, in 2025, something is happening to this industry that makes the leverage problem look manageable by comparison. Every major firm on Wall Street, Goldman Sachs, Citadel, Two Sigma, Jane Street, is running AI-powered quantitative models that execute hundreds of thousands of trades a day, scanning every earnings report, every satellite image of a parking lot, every credit card transaction dataset, every FDA filing, simultaneously, in milliseconds. The edge that a discretionary manager used to get from reading a 10K faster than the next analyst, spotting a management change before it hit the news, identifying a supply chain disruption before the market priced it. That edge is being competed away in real time by machines that read every 10K at once. Here's the trap. If your strategy worked long enough to build a track record, it worked long enough for someone to build a model around it. The moment you show institutional investors 3 years of audited returns and go out to raise money, you're also showing them the exact pattern a quant team will spend the next 6 months reverse engineering and running at a fraction of your fees. Warren Buffett saw this coming. In 2007, he made a public bet. A simple S&P 500 index fund would outperform a basket of actively selected hedge funds over 10 years. The hedge funds returned 36.3% over the decade. The index returned 125.8%. The fund of funds manager who picked the hedge funds acknowledged the result. He collected his management fees the entire time. The question is not whether your fund survives a bad year, it's whether the category of thing you do still has a buyer in 10 years. For most funds operating today, that is not a comfortable question. Time to pull it all together. How much money do you actually make if you do this right? 2 scenarios, real numbers. Scenario 1. You raise $200 million from a combination of family offices, wealthy individuals, and one small institutional allocator who took a chance on you. Your management fee is 2%. That's $4 million a year. Your operating costs, team, technology, legal, audit, office, run $2.5 million. You're netting $1.5 million before you've generated a single return. Your personal capital commitment to the fund, the amount you were required to put in alongside your investors, was likely $500,000 to $1 million. In year 2, you return 12% net. Your performance fee at 20% on $24 million in profits is $4.8 million. Total take home in a good year, $6.3 million on $500,000 of your own money in. That is the business. After 5 years of consistent performance, your assets under management have grown to $500 million through new allocations. Management fee is now $10 million. Performance fee in an average year adds another $8 to $12 million. You're running a real business. Scenario 2. You raise $5 billion from pension funds, sovereign wealth funds, and large endowments. Your management fee at 1.5%, because allocators of that size negotiate, is $75 million a year. Your cost structure is heavier, but even at $30 million in annual operating costs, you're clearing $45 million before you've made a single trade. In a strong year, 18% net returns, your performance fee on $900 million in profits is $180 million. Your personal cut, assuming you own 30% of the general partner entity, is $53 million in 1 year, and you don't have to win every year to stay in business. The $75 million management fee runs whether you're up, down, or flat. The richest man who ever ran a hedge fund was Jim Simons. He hired mathematicians instead of traders. He refused to hire anyone with a finance background. He built a single model, made it available to every employee at once, and refused to take outside money once it was working. At his death in May 2024, his net worth was $31.4 billion. His medallion fund generated $100 billion in total trading profits over 30 years. Not returns, profits, the gross number before fees. And here's the detail that matters most. After charging 5% management and 44% performance, more than double what any other fund charges, Simons investors still made 39% a year net. The fee didn't matter because the alpha was real, which is the only thing that's ever mattered in this business. Not the structure, not the prestige, not the models, not the Nobel Prizes. The alpha. Everything else is just a very expensive way to find out you don't have it.